Key takeaways from Jerome Powell's Jackson Hole speech appear to be, first, Powell is very strongly focused on the 2% inflation, perhaps a little more than what the market is giving him credit for. Takeaway two, restoring price stability is going to take time. He says Powell seems prepared for a sustained period of below-trend growth. So even if growth is bad, they won't flinch. Takeaway three, in September itself, he is quoted largely from the July statement, but the general impression seems to be that it could be another 75 basis hike, though, of course, he did say the FOMC will be data dependent. Takeaway four, he said inflation is due to higher demand and constrained supply, but that's not going to change the resolve of the Federal Reserve to bring down demand in sync with supply. Important. Takeaway five, he said longer-term inflation expectations do appear well anchored, but that's not ground enough for complacency. And the most important takeaway six, historical record cautions against prematurely loosening policy. The lesson from the 70s and the 80s, he said over and over again, is that if we waver now, then a lengthy period of tightening will be called for, giving the impression that there is no cut in his horizon. Now, the impact of the speech on the market, the CME Fed Watch tool is now showing that the chances of a 75 basis point hike has risen to 61% from 47% in the previous week. Also, all emerging market currencies have opened with cuts of between 0.2 to 0.8%. The rupee itself has hit a fresh low, all-time low of 80.12, but then a goodish bit of Reserve Bank selling of dollars has brought it back to the 80 mark. Joining me now to parse the impact of the Jackson Hole speech from an emerging markets point of view is Vishnu Varathan, Executive Director, Head Economics and Strategy, Asia and Oceania Treasury at Mizuho Bank. Well, Vishnu, thank you very much indeed for joining us. Now, according to this CME Fed Watch tool that I refer to, chances of a 75 basis point hike in September has gone up to 61% from 47%. What is your own expectations in September?
I think, to be very frank, our own estimate and our own, forecast was for 50 basis point hike. But I think the fact that he has reiterated this point and particularly come to the aspect of inflation expectations means markets are probably correctly pricing in that there's a higher chance of 75 basis points rather than 50. But if we take a step back, the bigger picture is that from June till September, the entire Q3 or rather Q2 to Q3, we haven't backed away from the big question remaining the same. And that question is, it continues to be, is it a 50 or 75? So the Fed has got no chance and no room at this point to scale it back to a question of 25 or 50. So in other words, 50 continues to be the new 25. And I think now markets, the bigger question for them is whether in November and December, the Fed will have any scope to step back to a 25 basis point hike. And regardless of the current pricing, two things that will determine this are incoming data, and perhaps in September, very importantly, the revised so-called dot plot, the median of the Fed forecast.
Of course, we will watch for the dot plot. But Vishnu, would you say the real big takeaway is that there is no cut in 2023?
I like that you hit the nail on the head. And I think that was one of the biggest takeaways as well, because one particular point that he continued to, that Fed Powell emphasized on during this meeting is that they need to hold rates restrictive for a relatively long period, even if that meant having to deal with a sustained period of below trend economy. And so that has been one of the bigger revisions in terms of how markets are pricing this. The peak rates are perhaps not going to come through as emphatically in the early part of 2023. And I think the dot plot will confirm that perhaps the rates may remain elevated through 2023. So to your point, expecting and hoping for a rate cut in 2023 may be a little bit overdone.
Okay. Yeah, we will again look for the dot plot. But what are the chances, Vishnu, of the Fed funds rate going even above 4%?
I think these chances are increasing. And to be clear, he did Fed Chair Powell did not expressly allude to this, although he did mention, in between the lines in terms of the three lessons that they have, having to, act decisively, unconditionally, and ahead of expectations. But just before Jackson Hole, we've seen even the less extremely hawkish members of the FOMC suggesting that they see higher rates. And I'll give you two examples which may be guiding in terms of how the FOMC may be moving towards. Esther George, Esther George, I think expressly said that 4% may not be ruled out. And James Bullard had an even more fundamental suggestion that maybe 2.25 to 2.5% may not be the neutral rate, and the neutral rates might have moved up one way or the other. This is knocking up against 4%. So assumptions that will definitely halt before 4%. That is also looking shaky at this point of time.
Okay, we'll have to wait and see how the markets react to that. But today, we already know that the emerging market Asia currencies have fallen between 0.2 and 0.8%. Now, do you see more weakness in EM currencies? Particularly, what's your view on the rupee?
Well, we do think that in the near term, at least heading into September and the early part of October, there are two key reasons why we can get more weakness in EM currencies. First of all, today's weakness is perhaps understated because as we were heading into the Jackson Hole, markets were already accounting for a stronger dollar. So it may not fully price in the extent of hawkishness. The other reason is heading into September and October, there are two things that are going to happen. One is not only is the Fed likely to deliver at the top side of the 50 to 75 basis point hike with still hawkish comments, but the dot plot is also likely to be somewhat more aggressive. And we may also be bracing for a doubling of quantitative tightening to 95 billion a month from 47.5. So the confluence of these factors suggests the dollar is likely to remain underpinned and supported. And the other reason is even if the ECB and the Bank of England are turning more hawkish, they fall far short of the Fed. That's one. And the other is they face far greater recession and stagflation risks, which is to say the alternative of going into the euro and sterling are less compelling. And that by default means that the dollar is likely to retain strength for longer into this global tightening cycle. So we don't want to dismiss the dollar as having peaked in Q3 just yet. To the question of how much further EM currencies can go down, our suspicion is this is somewhere in the ballpark of, say, 2 to 5%. We do expect the dollar rupee to at least fleetingly test above 80, getting close to 81. But there may be some relief from any coincident softening in oil prices due to the rising recession risks that come along with aggressive Fed tightening.
Okay. Well, let me come to India. The Indian growth story has been pretty strong in the first half. Can this growth be hurt by slowdown in China and eventually slowdown in the US as well?
So I'm just going to be a little more provocative here. I'm going to suggest that actually US-China may be a medium-term boon for India, because that means you would get a lot more investments heading India's way, insofar that many multinationals and all will have to hedge away from China. So in the medium term, I see it to continue to bolster and burnish India's underlying strong fundamentals. In the near term, however, the fairly strong first half, and by that I mean the first calendar half performance, may be overstated by base effects, because even if we expect double-digit growth in Q2, the fact of the matter is, compared to pre-COVID, it's up barely 4%. So it's just an ongoing recovery distorted by base effects, whereas the incoming headwinds alongside a tightening RBI and components of inflation, including food that looks sticky, means that the path ahead might be bumpy. And I think getting to the trend growth or potential growth between 7 and perhaps even 8% may have to be deferred out beyond 2023.
Let me take that provocative part. According to you, which is the most attractive economy in Asia EMs? And is India likely to see good foreign flows, continue to see good foreign flows?
I think India is certainly one of the most attractive because it's got the dual allure of being a fantastically big manufacturing base with economies of scale and supportive labor force, as well as a domestic market. So that twin engine is fantastic. But that's perhaps over a longer timeline of, say, 5 to 15 years. The immediate reflex, I think, favors countries such as perhaps Vietnam, to a lesser extent Malaysia and Philippines a little more, just due to the fact that it will be easier for them to plug into existing logistics and infrastructures. So that's how we look at it in terms of deferring horizon. But I think there is every evidence to suggest that FDI flows into India will continue to be very supportive once we look past some of the near-term bumps in the global economy.
Good to hear that, but actually my question was with reference to portfolio flows. Now, FPI flows did return in August. Are they likely to continue, or do you think they'll take a break with all this hawkishness?
That's a really good question. And sorry, I went the FDI route earlier. For FII flows, we expect that it will resume, but not in a linear fashion. I think there are still some bumps and air pockets ahead, in particular due to the whole concept of higher for longer US rates coming through. That will need to be factored in. The inflation differentials is another one, because we probably have probably see a sign of US inflation peaking a little bit before Asia and India's inflation peak. So the inflation differentials going the other way, favoring the US, also means that some of the capital flows will at least be interrupted for the rest of the year. And so it's not going to be an unimpeded improvement in FII, but looking beyond that, there would be a greater alignment between FDIs and FIIs, because you go back to underlying fundamentals, and then I think we will start looking at a more sustained and robust recovery in the FII.
Okay, we will take your medium-term optimism with both hands. Thank you very much, Vishnu Varathan, for joining us. We have to wrap up on Bazaar on that note with the news that the equity indexes have shown a decent bounce back, but two events are there. When London opens, we could see, we have to see how foreign funds react. And secondly, by 1 o'clock or 2 o'clock, we're going to get the Reliance AGM speech. So both those can have an impact on the market. We wrap up on Bazaar. Chart busted up.